Neil, is it cheap even if we have a no-deal Brexit?
I think it is, yes. A lot of that's already priced in.
So we've all seen the headlines before. This stock is cheap, that stock is cheap. What is it exactly that makes a stock cheap? Let me give you an example. I'm gonna put 3 stocks on the screen right now. Which one of these 3 stocks is the cheapest?
This is the $150 one?
No, that's what I thought you oh, you have another question?
The $150 one cost the least.
Okay, that's enough talking from you. The answer is Google. That's good. To be honest with you, that was a pretty easy one. It seems like you pretty much know what we're gonna be going over today, so why don't you tell him how you knew that? Did he just leave to go watch Nyan Cat 10 hours? Not you though, you're gonna stay and hit the thumbs up button, you know, help me out with my watch time a little bit, you know, learn something today. That was a weird intro, but I'm kind of a weird guy and you'll get used to it. But welcome back to the channel. You'll laugh, you'll cringe, you'll learn something. Hopefully you'll learn something. Hopefully you'll laugh. You might just cringe. As you can see, topic of the day is how to value a stock like Warren Buffett. We're gonna be going over the concepts that are in this book here. This book is about 500 pages and I probably won't read it to you in this 10 to 15 minute video. But if you wanna see that 2-hour video, coming soon. The concepts that we're going to go over today are going to help you invest within what Warren Buffett calls the margin of safety. Essentially what the margin of safety's goal is to do is to put you in the best position to make gains over time, not making these speculative wild rides that a lot of people like to take in things like Bitcoin and other types of very speculative investments. Not downing those things if that's what you do. If you're a trader, do your trading thing. The margin of safety is going to let us make those gains over time and just be patient, hang in there like he has, and just build wealth over time so we can have a wonderful adult life and retirement. So let's pop over to the notes here and we'll see what terms we're going to be going over today and why they are important. Things that we're going to be examining in our story today are financial condition, debt levels, earning stability, capital returns, which is basically giving money back to the shareholders, earnings growth, and a price to earnings ratio under the industry average. The book recommends a 15 price to earnings ratio. In today's day and age, my personal preference is to invest in companies that have a price to earnings ratio underneath the industry average. It's a little bit hard in today's market to find companies with a price to earnings ratio under 15 unless they're in serious trouble. So typically with those companies, you want to look into those very carefully and see what's going on under the hood because something very drastically bad could be going wrong with that company. So without further ado, let's get into this story. So picture this, you're running a lemonade stand. You've got one employee. Let's call him Billy. I know that's not his real name, but you're a capitalist now. It has nothing to do with how to value a stock, but this is my story. Billy is able to sell $100 of lemonade a day. You work Billy's 365 days a year, so he brings in a total of $36,500 in profits. So now we've got our first term, revenue. Given the fact that our business is doing so much revenue per year, people should be willing to pay a certain amount for this business. In theory, if the business were to double its revenue, people should be willing to pay twice that amount. But that doesn't quite paint the full picture because we still haven't paid our employee. So after paying our employee $17.80 a day, we come out with a nice round number of $30,000. This is our second term. This is our profit. Now stay with me, this weird story's going somewhere, I promise. Every public company has a valuation that determines how expensive the company is as a whole. This is called the market capitalization. If you take the entire market capitalization and divide it by the shares outstanding or how many stocks there are in the market, that's how you get the stock price. So we've got two things. We've got price and we've got profits or earnings. If we take those and put them together, we've got a price to earnings ratio. The question you should be asking yourself when you're looking at a price to earnings ratio is, what am I willing to pay for ownership of these earnings? And it's for that reason that in and of itself, a higher price to earnings ratio is actually a bad thing because you're paying more for fewer earnings. I've had a lot of people come up to me and say like, oh, look at this Amazon, it's got like 100 price to earnings ratio. That's so high, it's great, I'm gonna buy in because they see Amazon's a great company and it has a high price to earnings ratio. But that's because people are willing to pay more for those earnings because they're growing at such a rapid rate. We'll get into that in a little bit. So if we follow the tenets that were laid out in Benjamin Graham's book that Warren Buffett follows, we want to get into the stock for under a 15 price to earnings ratio. In other words, if you owned 100% of the stock and 100% of the company, the earnings would replace the price that you paid within 15 years, assuming they don't go up or down. Pretty decent deal, right? On the other hand, if you've got a price to earning ratio of 100, those earnings are going to take 100 years to replace the price that you paid. So let's get back into our lemonade stand. To purchase a lemonade stand making $30,000 in profits each year at a price to earnings ratio of 15 or under, we would want to purchase a lemonade stand for a price of $450,000 or less. If I happen to be choosing between two different lemonade stands, using only this method, I can start to see which one is the cheapest. So that seems pretty easy, right? It's easy to value stocks, you just figure out which one's the cheapest. Well, not exactly. That is the easy part, but the rest is more of an art than a science, because when you're buying a company for cheaper or more expensive, you need to ask yourself the question, why? And this is where investing gets a little bit more complicated. This is where things get a little bit more complicated, so let's talk about current assets. In Benjamin Graham's book, he recommends that you have at least 1.5 times current assets compared to current liabilities. So on the asset side, we're talking cash and cash equivalents, things that can immediately pay off debts and obligations. And on the current liability side, we're talking about debts that are going to be due this year. Let's go back to our lemonade stand. Let's say we want to start growing. So we take out a $15,000 one-year loan to prop up more lemonade stands. In theory, we should increase our earning potential, but this introduces risk into the business. However, we've got $30,000 on the balance sheet from last year, and the value of the first stand is $500. Therefore, our current assets are $30,000 and $500. In the event that we needed to pay off our current liabilities, our current assets are 2 times the amount, approximately, of the debt that we just took out. If anyone were coming to purchase our questionably run child business, they would come and they would see our balance sheet and they would see that there's a really loud lawnmower right outside my door right now, isn't there? Just gonna keep going, so I'm just gonna keep going. No, I'm not. This is Jesus Christ.
2,000 years later.
If anyone were coming to purchase our lemonade stand, they would see that we have twice as many assets as liabilities, and they would say, hey, this is a pretty safe business. In addition to above a 1.5 current ratio, this book also recommends that your debt not be more than 110% of your current assets. We make the bill for that recommendation because our current assets are 200% of our current liabilities. All right, what are we missing? I promised you something else. Capital returns. So basically what capital returns are is they could be in the form of dividends or share buybacks. It's basically the company taking the money that they brought in and giving it back to the shareholders, either in the form of buying back shares, which essentially means there are fewer shares on the market. When you buy more shares, companies buy back shares. The company is still worth about the same amount, but there are fewer shares outstanding. So the people that retain their shares are worth more now. Whereas a dividend is a monthly, quarterly, sometimes semi-annually, sometimes annually cash disbursement to the investors in the company. All right, and the last thing I want to do is just go over the thing that is going to blow your mind and make you understand the nuance in investing. And that is that not all earnings are created equal. One of Benjamin Graham's tenets is earning stability. So here with our company, we're a brand new startup. We don't have really any earning stability. What he recommends is that you pick companies that have been growing over the past 5 to 10 years. Basically, he wants to see earnings that are increasing year over year. What that's basically going to do is ensure that you're going to continue to grow your investment over time, and you're going to continue to see increasing capital returns over time. So let's talk about growth. Let's say that stock A is selling at a purchase price of $10 and earnings per share is $1. Stock B is selling at a price of $10 and earnings per share is also $1. During year 0, each stock has a price to earnings ratio of 10. Stock A is growing earnings at 100%, whereas Stock B is growing earnings at 10%. After year 1, Stock A has a price to earnings ratio of 5, a $10 price, and a $2 earnings. Stock B has a price to earnings ratio of 9.09 at a price of $10 and $1.10 in earnings. Purely based upon buying under a 15 PE, it now makes sense to buy Stock A up to $30 and Stock B up to a price of $16.50. Knowing this, investors will pay more initially for companies that they know are growing revenues. However, when prices get bid up to a certain amount, there's a diminishing return on your investment. So to recap, you got to think about how much you're paying, you got to think about growth, you got to think about earning stability, and just generally the condition of the company as a whole. Hopefully you guys enjoyed the video. If you did, make sure you give it a like, comment something down below. I'll see you guys in the comment section, and I'll see you guys in the next one.